Hi, this is Ashish Shaker and I'm happy to present to you the May version of our monthly publication Alpha Strategist. It's been a very interesting and volatile month. The report is titled Game of Thrones. It's aptly titled because we're going to finally see who sits on the Indian throne on May 23rd, which is the date on which you'll see the outcome of the general elections. There is a lot of anxiety as well as anticipation in terms of who will form the next government, and we'll surely know the results in the next 10 days. However, globally, trade tensions have escalated again between US and China, and this is causing anxiety in global markets. We saw the Dow selling off almost close to 500 points. This is impacting emerging markets as well, and India is no exception. We've seen FIs pull out a lot of money over the last few days, and the Indian markets have also corrected close to 5 to 6% in the large cap space. The broader markets have again corrected similarly. In certain cases, it's corrected more. Whilst we do believe that the longer term story for India looks very promising, and it's a story of consumption, the desire for better discretionary goods. We are also seeing slowly infrastructure development as well as capacity utilization in a lot of the depressed sectors pick up. However, in the near term, we are seeing several challenges and headwinds, especially in the consumer sector, which is facing a headwind in terms of demand. This is further getting compounded by lack of funding across many sectors due to the crisis in the NBFC space. We saw a large NBFC default in September last year. Things since then had improved. However, we are again seeing a resurfacing of liquidity problems in the money market, which is impacting the ability of a lot of NBFCs to refinance their borrowings. Government is doing a lot in terms of putting liquidity into the markets. RBI has done a couple of swaps to attract foreign money into the Indian markets. However, still we are seeing that some of the known names, the tier 1 names, basically NBFCs run by industrial houses, they are able to attract capital. But some of the tier 2 names and tier 3 names are still finding it difficult to refinance their obligations. So it is a stressful period that we are going through. One still doesn't know how this situation will get resolved. We are hoping that the government as well as the central bank act decisively. I guess the decision making should accelerate once the new government is in power. But till then, on the fixed income side, our recommendation is to be extremely conservative. We put out a note sometime last month outlining our recommendations. These are basically liquid funds, or these are near-term corporate bond funds, which extremely high quality paper, and we continue to recommend investing in these kind of funds. As regards the credit space, some of the AA yields have become very attractive, and like we had messaged in our last month's publication, we are watching this space very closely, and as and when we have comfort that things in the money markets are improving, we will definitely come out with our list of recommendations in this space, because absolute yields have become very attractive. They are closer to double digits. Coming to equities, we find that this result season, which is almost 2/3 over, the Nifty companies grew top line by about 13% and bottom line by about 9%. There has been disappointment across few sectors, mainly consumer. There were headwinds in the automobile sector. Even the messaging from a lot of the staples companies point out to a volume slowdown, and they point out to slower demand in rural areas. So going forward, I think earnings from the consumer sector look a little challenging. Corporate banks were supposed to drive the earnings growth for this quarter. We have seen a lot of improvement of the loan book. Two of the largest corporate banks, SBI and ICICI, have shown much improved balance sheets. They have reduced their NPA books, the SMA accounts. However, this quarter, the trend that we saw was they chose to take higher provisioning on their NPA book. Hence, the profit growth has got postponed. So both these banks have declared lower profitability as opposed to expectations, and that is the trend we see across many corporate banks which are saddled with NPS. However, what this does is that it improves the visibility of earnings for next year. So we continue to remain bullish on these themes. But if I were to sum up the earnings season and the outlook for next year, what is happening is that the corporate banks are expected to drive bulk of the profit growth. Almost if the expectation is 18 to 20% earnings growth, then almost 8 to 9% is expected to come from corporate banks. Consumer sector, you will see a slowdown or deceleration in earnings in certain sectors, especially automobiles. So the rest of the pack, IT, consumer, will drive about 10 to 12% kind of earnings growth, and there could be some cuts. So we are staring at a nifty earnings of 477 for this financial year. Now on this base, valuations appear a little stretched in the large cap space. In the mid and small cap space, they appear closer to averages, long-term averages. However, one has to consider that you are sitting at a depressed profitability for corporate India. So all in all, it's a mixed bag, and like I said, the funding challenges in the NBFC sector is not helping. So we recommend a little bit of caution on equities. Anybody who wants to add on equities should do so gradually, and at any sharp dips you could look to increase allocations. People who are adequately allocated can stay invested. It's best to review your portfolios and see if you need to make any changes. In the fixed income space, people who have credit funds, we would love to do a one-on-one review, and we've been doing this over the last few months, and see if you are overexposed to the credit space, and if we need to moderate that exposure. Incremental money we are only recommending in high quality accrual strategies, and we've already put out the recommendation. Having said that, the longer term story of India looks intact, and I think the best way to go through such stressful situations is to ensure that you have a well drafted investment charter for your wealth management journey and your portfolio as a whole. If you do not have an investment charter, please reach out to any of our advisors and ensure that you discuss your objectives and longer term wealth management journey and get the charter done. So that's it from me. Thank you very much.